Get ready for the action, because we are diving straight into the biggest stories dominating the markets right now. We start with Roblox making a massive strategic move to unlock new growth in the Indian market. Learn how Roblox is tapping into the potential of India by bringing in senior leadership like Sunil Rao, and what this means for the company's international monetization strategy and creator ecosystem. This move is set to redefine how Roblox captures value in one of the world's fastest-growing digital economies.
Stop using your finger for notes, sketches, and edits. This Jam Jake stylus pen gives your iPad a smoother, more precise writing feel with palm rejection so your hand can rest naturally on the screen. It charges fast, works for hours, and comes with replacement tips. Perfect for school, work, or creative projects. Check the link in the comments to grab it on Amazon.
Next up, we turn our attention to the dynamic world of language learning and the financial health of Duolingo. We break down the stark forecast issued by the Duolingo CEO for 2026, exploring the challenging environment where rising engagement is no longer enough to sustain the growth narrative. We will investigate the trade-offs management is making, especially concerning AI investment, and whether the company can navigate cooling monetization to secure a stronger future. Now, let's shift gears to industrial and global trade with AGI announcing its first quarter 2026 results and progress on monetizing accounts receivable in Brazil. We look closely at the financial figures, noting the dip in adjusted EBITDA margin and the strategic actions, including releasing significant receivables, that management is taking to strengthen the balance sheet amidst challenging commercial volumes in North America and India. And finally, we wrap up with a deep dive into the complex financial outlook for AGI, examining the order book performance and the significant restructuring plans underway. We'll analyze management's projections for cost savings and debt reduction, giving you the full picture on how AGI plans to navigate global trade uncertainties and what this means for investors. Don't miss a second of this critical analysis, so hit that subscribe button and join our community now for all the latest market intelligence. Roblox is strategically deepening its international presence, appointing Sunil Rao to lead operations in India, signaling a significant focus on monetizing growth within the key Indian market. This move underscores Roblox's broader strategy to localize products, content, and partnerships as global gaming and creator economies increasingly prioritize emerging markets. For investors tracking NYSE, RBLX, this senior leadership hire suggests India is becoming central to the company's international expansion plans. Rao's background in large technology firms and venture capital is expected to be instrumental in forging crucial relationships with local developers, brands, and distribution partners. While the financial impact of this strategic shift may take time to materialize in reported results, it is positioned to enhance the creator pipeline and refine local partnerships. This initiative is crucial as Roblox navigates near-term challenges, including adjustments to safety rules, which have impacted recent sales figures and new user acquisition. Analysts are closely monitoring how international segments, particularly in fast-growing regions like India, contribute to overall bookings and cash flow. The key narrative for investors now centers on whether India can transition from being primarily a user growth story to a meaningful contributor to bookings and cash flow, alongside the speed at which local creators adopt platform tools and compliance requirements. Management commentary on international trends, especially in the Asia-Pacific, and the effects of age verification restrictions on user engagement in India versus established markets are points of intense scrutiny. Furthermore, regulatory developments concerning child safety and Roblox's competitive positioning against platforms like Fortnite and TikTok are vital factors influencing the investment narrative. Zacks Investment Research has published an analysis questioning whether Duolingo is successfully building a high-quality monetization engine. The research, authored by Shuvra Shankar Day and dated May 6, 2026, delves into the company's monetization strategies and their long-term viability. The report suggests a critical examination of Duolingo's current approach to revenue generation, indicating a focus on whether the platform is effectively converting its user base into sustainable financial returns. This analysis is relevant for investors and stakeholders assessing Duolingo's growth trajectory and future profitability. Duolingo's outlook for 2026 has shifted to uncertainty following disappointing guidance, causing the company's stock to drop 6% and adding to a significant drawdown over the past year. The narrative of clean growth is evolving as rising user engagement alone is no longer sufficient to drive the business. Management is strategically prioritizing heavy investment in product development, particularly artificial intelligence, which is creating trade-offs in monetization, slowing bookings growth, and margin pressure at a time when investors seek clearer revenue conversion metrics. In the first quarter results, Duolingo reported total bookings of $308.5 million, marking a 14% year-over-year increase, while revenue hit $292 million, up 27%. Although paid subscribers reached 12.5 million, a 21% increase from the previous year, this subscriber growth is not translating into commensurate bookings growth. Management has forecasted a slowdown in Q2, with bookings guidance of $283.5 million, a modest 6% year-over-year increase, and a projected full-year 2026 bookings of $1.28 billion, up 10.5%. While management anticipates bookings will re-accelerate in the second half of 2026, the slowdown in Q2 is a concern, as bookings serve as a key indicator of revenue efficiency. Management attributed the slowdown to challenging comparisons from last year's Max rollout, prior pricing strategies, and stronger ad revenue in earlier periods. However, CFO Gillian Munson characterized 2026 as an investment year, signaling a strategic pivot toward product enhancement over immediate conversion and pricing leverage. The company is focusing on speaking features, AI tools, and the free user experience, betting that these investments will eventually boost conversion, retention, and average revenue per user, ARPU. A significant headwind is the rising cost of AI integration. While the company achieved a strong 73% gross margin in Q1 2026, management expects this figure to decline to approximately 69% by year-end, as AI features are adopted by more users. This margin pressure is directly linked to increased AI usage and broader feature adoption, suggesting a structural change in product strategy. Despite these headwinds, AI is proving to be a catalyst for product depth. Duolingo has accelerated its content creation, publishing 20,500 course units in Q1 2026, up sharply from roughly 7,100 in 2025. Expansion into B2-level content, enabling users to hold complex conversations across 9 languages, demonstrates AI's ability to enhance content breadth and speaking functionality, areas historically limiting language apps. This deeper offering is expected to improve retention and strengthen the case for premium tiers. The core challenge remains translating deeper engagement into stronger paid conversion and pricing power before weaker bookings and margin compression force a reassessment. The future hinges on whether AI-driven product improvements can successfully lift revenue per user, rather than just deepening engagement. While AI is accelerating product development and strengthening the competitive moat, the immediate focus must be on improving subscriber economics. Ag Growth International Inc., TSX, AFN, has released its financial results for the first quarter of 2026, revealing a mixed performance across its operating segments amid challenging market conditions. For the 3-month period ending March 31, 2026, the company reported revenue of $282 million, a 2% decrease year-over-year, and adjusted EBITDA of $25 million, down 19%. The adjusted EBITDA margin declined significantly to 8.9% from 10.9%, primarily driven by lower commercial volumes, although corporate cost reductions provided some offset. The farm segment demonstrated resilience, with revenue increasing 7% year-over-year, boosted by higher sales across North America. However, Its adjusted EBITDA remained flat due to shifts in product mix. Conversely, the commercial segment faced headwinds, with revenue falling 6% due to a soft market in North America and impacts from geopolitical and domestic policy issues in India. This segment saw a substantial 44% drop in adjusted EBITDA, reflecting lower volume and product mix. Management noted that selling, general, and administrative expenses excluding certain costs were $9.7 million lower than the prior year, aided by corporate restructuring initiatives. The net debt leverage ratio stood at 5.2x as of March 31, 2026. Looking ahead, the order book showed a 19% year-over-year decline to $589 million, largely due to the completion of major projects in the international commercial segment, although the farm segment order book saw a modest improvement. The commercial segment order book declined due to cautious customer behavior. A key business update involved the release of approximately $105 million related to long-term accounts receivable in Brazil from escrow. About $55 million has been received into AGI-controlled accounts, with the remainder expected to be transferred in May 2026. These funds are earmarked for debt repayment on senior credit facilities, which is projected to reduce the net debt leverage ratio pro forma to 4.7x. Interim President and CEO Paul Brisebois commented that the results reflect a challenging operating environment, emphasizing decisive actions to simplify the business and align costs, with management now estimating annualized cost savings of at least $30 million, expected to be fully realized by the fourth quarter of 2026. The company continues to navigate risks associated with tariffs, global economic volatility, and supply chain disruptions, while focusing on executing its restructuring plan to strengthen its balance sheet.